Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to go over all of the new recent foreclosure information. And then after the foreclosure information, we're going to take a good in-depth look at the health of the consumer. And in today's video, you guys are probably going to be as shocked as I was when I went over the information when it pertains to credit card debt. Credit card debt, y'all, is outpacing car debt by double over the last 2 years. An astonishing amount of households right now are absolutely drowning themselves in horrible credit card debt. Now, as we said, as far as foreclosures, we're almost at 250,000 homes that are fixing to hit the market as foreclosure inventory. So that's all the stuff we're going to look at today, you guys. And if you can, do me a favor, like this video, subscribe if you haven't already, shoot me a comment below. And either way, you guys, I really hope you enjoy this video. Now, as always, we're going to go over the Black Knight information. It will be linked in my description. I also like going over ATTOM, but my preference is Black Knight, even though the information is lagging. And honestly, I really suggest you guys following along because their reports are really in depth and it has a lot of detail. They come out with this initial report and a couple weeks later, they actually give us about 30 additional pages with graphs and additional data to break down. So Black Knight is actually a really good source of information. Now, the name of this article is Past Due Mortgages Approach Recent Record Lows as Serious Delinquencies Continue Improvement. Prepayments see seasonal rise. So what does all this mean? Let's take a look. As far as the actual defaults, we had a great month where it actually went down. Talk about whiplash, guys. What's with the whiplash, right? Anyways, let's take a look at the bullet points. Reversing much of April's calendar-driven spike, the national delinquency rate fell by 1.1% in May to hit 3.1%, the lowest it's been other than March of 2023's record of 2.92%. So we're sitting at 3.1%, insanely low. The number of borrowers a single payment past due improved by a whopping 94,000 mortgage holders, or negative 9.5%, erasing nearly half of the prior month's increase. So last month was really bad, but this month is actually good. What's with this data, right? Serious delinquencies, loans 90 days or more past due, continue to improve nationally, falling by 18,000 or 3.7% from April, putting this loan population down more than 20,000, nearly 30% since May of 2022. Remarkable improvement. That is a remarkable improvement from serious delinquencies, because remember, you guys, serious delinquencies is like the biggest at risk of going into foreclosure. Foreclosure actions were started on 5.1%, however, of serious delinquencies in May, up only marginally from April, still more than a full percentage point below the March 2022 rate and the start of the pandemic. So this is a little bit muddied, right? It's saying it fell by 3.7%, but 5.1% went to the next stage. So the reality is that wasn't necessarily a marked improvement in serious delinquencies, because a lot of those, actually more than what it fell by, actually went into additional foreclosure actions. So you got to be a little bit careful what you're reading here. The number of loans in active foreclosure improved by 4,000 during the month and is now down to 41,000, negative 15% from March of 2020. And foreclosure sales completions have gone up 5.5% in April to 6,800 homes sold. So they sold 6,800 foreclosures in May. Prepayment activity somehow rose, and I say somehow rose because this basically means refinancing. I'm not talking about HELOCs, okay? Refinancing. And when you refinance, when we have an environment of elevated interest rates, that means you're essentially, more than likely, depending on when you purchase, you're trading in your super duper low interest rate for a super high interest rate. Now, why on earth would people do that? Well, if they can cash out $100,000 in equity to cover all of the credit card debt they're drowning in, it may be a good solution in their minds. Now let's look at our very interesting chart here. Now we really went over the first row. We're sitting at 3.1% as far as delinquencies. That's very low. That's a month over month change of 6.2%, year over year of 2.6%. So that is progress. There's undisputable progress there, at least so far. Now total US foreclosure presale inventory is 4.3%. That's down 2% month over month, but up 2% year over year. So it's pretty much sideways. Total US foreclosure starts, so the amount of homes that have started foreclosure is 2.16%. So again, what I was saying earlier is even though here it's showing that there's less 18,000, right? Here it's showing an increase of 25,000. So it is possible that number of properties that are actually 90 days or more delinquent actually increased, but we don't see it in this numbers because we have 25,000 more starts. Do y'all see what I'm saying? Again, improvement here. We're only at 1.6 million properties that are 30 days or more past due. Number of properties that are 90 days or serious delinquent is 483,000. Now, I know that sounds like a lot because that is a lot. However, historically, it's not too bad. And if you look year over year, it was actually around 700,000 a year ago. Now look at this here. This is what everyone wants right here. People want this inventory. There are 229,000 homes sitting in pre-sale inventory. And you guys, I don't know if you know this, but there's situations where you can actually try to purchase these homes before they're officially up for sale. So we have access to the pre-sale inventory. I don't know if you guys knew that or not. Now, total number of properties in distress, 1.86 million. That is down overall 112 households throughout the nation. Top 5 states with non-current percentages. Mississippi. Mississippi's leading the way. Mississippi's sitting at a whopping 7.3%. That's high. That is insanely high. That means 7.3% of mortgage holders, they're not paying their mortgage in Mississippi. Isn't that high to you guys? Is that a lot of people? But look at this. It peaked back in 2005 at 23%. Isn't that crazy? And look at the next state, Louisiana. All of us know that Louisiana is suffering. Louisiana's at 6.78%, but look at it peak. It peaked at 30%. Imagine 1/3 of households behind on their mortgage back in 2005. So even though it is super high, it is way far from peak. Now, that's more than I can say about Alabama. Alabama's at 5.33%. They peaked at 14.3% back in January of 2010. Now we got West Virginia, followed by Pennsylvania. And once again, you guys, look at the bottom states here. This is so crazy to me. So we don't have California on here anymore, but we have Oregon, Montana, Idaho, Colorado, and Washington. Washington's only at 1.92%. Do y'all think the reason that is because more people live together, like families living with families, like more families per housing unit? Do y'all think that's why? I think that's possibly why. There are so many families living together on the West Coast. It's unbelievable. But how can we explain the most unaffordable parts of our nation have the lowest non-current percentage? These numbers are wacky. And to me, it's just spelling out, hey, it's broken. It's eventually going to completely fall apart depending on what the government does and the type of quantitative easing. Now take a look at this. This is like the race. Who's like catching up right now? So this is the top 5 states by 12-month change in non-current. Now we saw Florida on this list because of the hurricane. Florida is now off of this list. Alaska's the number 1. But the thing that's crazy about Alaska, specifically Anchorage, Alaska right now is shooting up with prices. It has essentially not stopped. And I don't know why that is. Who wants to go to Anchorage? You know, I've been there fishing. I absolutely love it to visit. But Alaska, huge change of 25% in non-current. So people are starting to feel the unaffordability. However, it's still low, under the national average actually, at 2.99%. Isn't that astonishing? So in other words, if we're just going off of that data, everyone's going to say, oh, the consumer's in great shape. We're not going to head into recession because the consumers are going to continue to spend it. But the reality is here, guys, is yes, they had a whole bunch of excess savings. That excess savings is starting to dwindle rapidly. We've looked at data on that, and it should be extremely low by the end of this year. But also, the spending is coming from credit card debt, not from savings. Take a look. And y'all, this should really blow your mind. I'm going to show you why it should blow your mind in a second, but we're almost at 1 trillion. We still haven't quite hit 1 trillion. We're at $992 billion of credit card debt. And it really breaks my heart to see this because credit card debt, y'all, is the absolute worst legal debt you can get in my opinion. You pay so much to these credit card companies. It's just hard to fathom. But what I want to point out is this, okay? Look at this, you guys. So 2021, okay, so 2 years ago, only 2 years ago, listen to me, only 2 years ago, we were sitting at 754 billion, okay? What does that mean? That means in about 2 years, you guys listen, in 2 years, consumers spent $250 billion in consumer debt, in consumer credit card debt, or rather 250 billion. Again, listen to what I'm saying. In only 2 years, $250 billion was spent on credit cards. How is that possible? That represents roughly 25% of the current credit card debt that was obtained in just the last 2 years. That is a huge red flag about the consumer. That means that the shiny shoes, the Louis Vuitton purses, the Escalades, just kidding, Escalades aren't a thing anymore, but all of these cars you're looking at and all of these high living people, they're just wearing their debt. They don't even own the clothes on their backs half the time. And just to show you guys like how crazy the credit card debt is it outperformed the pace of auto debt. You guys, in the last 2 years, if we look at it's not going back to Q2, but if we look at Q3 of 2021 to right now, that's a $131 billion increase. $131 billion increase to roughly $250 billion, which means, as crazy as this sounds, over the last 2 years, the trajectory of credit card debt has almost doubled the trajectory of auto loan debt. Mind blown right now, y'all. Mind blown right now. There's just it seems to me that there is a massive band-aid on all of these bullet holes in the economy, and it's only a matter of time before the ship starts sinking like the Titanic. And we also see that here in the personal savings rate. It is so low right now because people can't save. It's only 4.1%. Okay, and now pre-pandemic, to give you an idea, we're at 8 and 9s. So we're saving at half the rate right now. And the reason that's such a big deal is because it's been decades since we've been able to get so much money on our savings. You guys, we have high yield savings account right now yielding 4, 5, sometimes 6%. And yet our savings rate is half of where it normally is. That means that people don't have the money to save, to make money off of. And people tell me all the time that buying a house is a great hedge against inflation. And I would normally agree, but the problem is the 50% run up in roughly 2 years basically squeezed out all of the value on the houses. So I believe that a great gauge against inflation is our money, is our cash, and not just leaving it like under our mattress. I'm investing mine in safe, high yielding treasury bonds. So I get almost 6% back on my money. You guys, that helps me with the inflation. And meanwhile, I don't have to buy a house and be chained to it. And this really shows the breaking of fundamentals right here. This is the S&P Case-Shiller. In other words, this is their calculation at determining home value, because we know that median sales price is not the best gauge for value. In fact, appraisals never use median sales price. They compare sold properties and their unique characteristics against the subject property in that subject property subdivision normally. But again, let's look back here in 2005. We can see this bubble here that formed, okay? This bubble formed here and it crashed. But look at this bubble here. This is what I'm saying. Housing is not a great hedge against inflation because of the bubble run up. And all of the people that say, oh, the housing market didn't crash, home values didn't go down. Yes, it did. It started out with home values declining at a faster pace than the great financial collapse. And right now, what I believe we're seeing seasonal uptrends, and it's going to be followed by seasonal deeper downtrends. You see that? Just like in 2009 to 2012, we had seasonal uptrends followed by deeper seasonal downtrend. Seasonal uptrend followed by deeper seasonal downtrend. After 2012, the housing market just rebounded. But this is the breaking of fundamentals. This is absolutely ludicrous to pay these prices and to shackle ourselves to this unaffordability. In my opinion, is like committing financial suicide. Now, that's not going to apply to everyone. If you're well leveraged, if you buy right now and your housing payment is maybe 20% of your income and you have proper expectations and you plan on writing this out for 10 years, odds are you're going to be safe. But the thing is, most people never plan for things like job loss, divorce, medical emergencies. And it's that situation that I'm really trying to warn people about. So in conclusion, the only way that I think that this house of cards is still standing is because of the lack of inventory in the housing market, but also because of the enormous amount of money printing and additional quantitative easing that has happened in 2023 of around $400 billion. And to put it in perspective, the bank bailout, like Silicon Valley bank bailout, was only about 20 billion. The discount window allowed almost anyone to trade in their toxic assets in exchange for performing assets. So the quantitative easing that happened again this year, yes, it did take us back to October of 2022, but my thing is it took us way further back than October of 2022 because we allowed all of those institutions to reset their assets. So the quantitative easing in 2023, in my opinion, you guys, extremely damaging to who? To you and to I, because we're going to pay that cost in the form of inflation. Other than that, I hope you guys got some value, some insights, and perspective from today's video. And if you are out there investing in real estate, you know I wish you luck. And I hope you win.